Buffett versus technology. Hey everyone, it's Wolfgang. We are in some volatile times in the stock market. A lot of people are looking at Berkshire Hathaway as a stable place to put money. The reputation of Berkshire Hathaway is stability, obviously. And so Berkshire Hathaway stock has been in demand because of the turbulence in the stock market. People see Warren Buffett as someone who seeks stable investments. And so the thinking is, in turbulent stock market times, Berkshire Hathaway stock is stable. It's a good place to park money. So the key thing is, if you're looking for stability in stocks, Berkshire Hathaway stock is a good place to park money. Okay, stability. So what I want to discuss here is, let's compare that to technology stocks over the long term, over a 20-year period, not in just turbulent times like we're having now, over a 20-year time span, from 2005 to 2025. So did some research. I've got a technology background. My undergraduate degree was in computer science. Previous to that, I had about 4 years worth of electrical engineering. So I started life in technology. I prefer technology investing versus the types of stocks that Buffett likes. So I wanted to cover this. Berkshire Hathaway tends to buy strong brands, that's his moat, with stable earnings. Stable meaning not just stable for a year, but stable over the long term. Long-term safe cash flows in the business, and not necessarily high returns. A lot of people think that that Berkshire Hathaway, his holding company, has provided great returns. That's not necessarily true if you start comparing, especially if you start comparing to technology stocks. Buffett prefers stable earnings. That's why in turbulent times, people like to invest in his holding company, because it's stable. So a lot of people are not really aware that he emphasizes stability over high returns. But that's actually the case, and I'm going to demonstrate that in this video. So let's look at the top some of the top holdings of Warren Buffett's company, Berkshire Hathaway, from 2005 to 2025. Coca-Cola has had a total return over 20 years of 400%. I happen to own Coca-Cola in the portfolio. I bought it a very long time ago when I was still buying individual stocks. I stopped doing that quite a while ago. But at the time I was buying individual companies, that was a safe place to park money. And so I bought Coca-Cola. See's Candy over the last 20 years has returned a total of 600%. That's another one of Berkshire Hathaway's holdings. Geico, the insurance company, has returned 450% over the past 20 years. General Re, which is the reinsurance company he owns. Reinsurance is the insurance company that insurance companies use. In other words, if you have car insurance and you make a claim because you had an accident, the insurance company buys insurance from a reinsurer. That's what General Re is. That's returned 150% over 20 years. And then his holding company stock, which is BRK, that's the ticker symbol, BRK, his holding company has returned about 350% over the past 20 years. Okay, so 400%, 600%, 450%, 150%, 350%. You sort of get the idea. Let's compare it to some technology stocks, some of the big ones. This is going to be shocking, okay? Because a lot of people are not really aware that Buffett does not necessarily seek high returns. He wants stable earnings, strong brands, long-term safe cash flows. Amazon has returned 45,000% in the past 20 years. 45,000%. Compare that to Coca-Cola. And you can say, why do you still own Coca-Cola? Good question. I wish I had sold it and deployed it into Amazon a long time ago, truth be told. Apple stock has returned 57,000% in the past 20 years. Let's compare that to See's Candy, 600%. You're seeing a trend, right? Technology stocks, the big ones, big returns. Google, 4,500% return over 20 years. So technology stocks, the most successful technology companies, sort of outpaced the annual returns of Berkshire Hathaway. That being said, if you want stability, technology stocks are probably not the right place to invest. Technology stocks are volatile, they're turbulent, they fluctuate much more than Berkshire Hathaway stock does. So if you're a nervous sort of person about putting money to work in the stock market, you're the type of person who would prefer the same thing that Buffett prefers. Strong brands that have a moat, because they're a brand like Coca-Cola, stable earnings over the very long term, long-term safe cash flows, not necessarily high returns. Okay, so why does Buffett avoid the high returns that are available in tech stocks? It's because, well, at least this is what he says, okay? And people misunderstand what he's saying here. But he says he doesn't understand technology stocks and other businesses too. But people have asked him during interviews that you can see online, on YouTube, for example, why he doesn't like some of these other stocks that seem to do pretty well. He doesn't understand them. Okay, so he does not mean he can't figure out what the company does. That is not what he means, okay? What he means is he doesn't understand how they fit into his scheme of the things that he likes. He doesn't understand that these technology companies are going to last 20 years because he wants to buy companies that are so stable that he can predict with some reliability that they will be around in 20 years. And he doesn't understand how some companies are going to fit into that. So he doesn't mean he can't figure out how Apple Computer works or how Microsoft or Google or Amazon work. He's not a stupid person. He totally understands how those businesses operate. What he means, and I don't know why he expresses it this way, because it's misleading. It sort of ties into his tendency to play down his own intellect. He tends to come off as being humble and to, not touting his own achievements too much. So he says he doesn't understand certain businesses, partly because he's, it's definitely not because he can't figure out how the business operates. It's because it doesn't fit into his preferred way of investing. He can't predict the last 20 years. He tends to want to avoid losing money. If you watch interviews, sometimes he will say, rule number one of investing is never lose money. Rule number two is never forget rule number one. So he avoids losing money. And you have to admit that there have been tech stocks that have been so turbulent and volatile that they drop quite a bit. And if you had to sell, you would lose money. And he tends to prefer avoiding that. So he doesn't like losing money. And some tech companies have gone out of business. Okay, so he also prefers a margin of safety, right? He often talks about being able to buy decent companies at fair prices. Margin of safety, he got that from Ben Graham, who was one of his professors at Columbia Business School. Margin of safety meant you're buying the stock for a value that's probably below what it's actually worth, so that if it falls a little bit, you don't get hurt. So the bottom line is Buffett is risk averse, okay? So over the long term, if you're risk averse, you end up with these kinds of returns. These are substandard returns. One of the reasons I did this video is because I'm a technology person. Those are awful returns, at least in my opinion, okay? I owned Berkshire Hathaway in the past. I couldn't help but compare it to some of the tech stocks that I owned, and I sold it. In my opinion, over a 20-year period, 350% over 20 years, when you compare it to some of the tech companies, it's awful. And I get why some people are risk averse like Buffett. They don't like the fluctuations in the stock price. They don't like the idea that, okay, tech changes so frequently, some tech companies could go out of business. I totally get that. So each person has their own investing preferences. There's nothing wrong with that. What I have a problem with is parking money, a lot of money, into a stock like Berkshire Hathaway that does very poorly in comparison. Okay, so I want to get to how you can safely invest in technology. As an example, the QQQ Exchange Traded Fund is a basket of the top 100 stocks. So this is a diversified portfolio of stocks. The top 100 NASDAQ companies, many of them are the biggest tech companies. Okay, the QQQ has blown away Berkshire Hathaway stock. Just, 850% return over 20 years. So if you were extremely risk averse and you didn't want to buy Amazon stock individually, and you did not want to buy an individual stock, Apple or Google, you could have bought technology very safely. The QQQ, as an example, I'm not trying to, this is not investing advice. I'm using QQQ as an example because it's technology related. It's heavily weighted technology. 100 stocks of the NASDAQ, 850% return over 20 years. Compare that to BRK stock, Berkshire Hathaway. Okay, so I'm not here saying you should invest in technology. If you don't like technology, you shouldn't invest in technology. I've got a technology background. I'm 100% biased, and here's why: because these sorts of companies, in terms of growth potential, growth potential is almost non-existent in these kinds of companies. Okay, technology, the underlying theme of technology is growth. If you look at NVIDIA stock, for example, technology invents new things. The best technology companies like Apple, for example, with the iPhone, gets wide adoption by consumers and businesses. And there's a lot of growth in technology stocks. You cannot get high growth in Berkshire stocks. Now, he did buy Apple. Somebody at Berkshire finally convinced him to look at some tech stocks. It may have been Greg Abel. I don't know. But when he started buying tech stocks, because I've known for a long time that he does not like technology because of the volatility. He wants a strong brand. He wants stable earnings. He wants to be able to look out 20 years and know with pretty good certainty the company's still going to be there in 20 years. Technology, very difficult to do that. Because Apple itself, even though Apple has had a 57,000% return over 20 years, at some point, Apple almost went out of business. It was right before Steve Jobs got rehired. Apple almost failed. And Buffett, that's not the kind of stock for him. So I was very surprised when he bought Apple stock much later, much more recently. But the QQQ, if you are a risk-averse investor, but you like technology, there are some options out there. If you own a basket of 100 stocks, that's a lot of diversification. And the QQQ is just one option. There are other exchange-traded funds that also have a lot of technology stocks in them, so you can look at that. But you only live once. We all have one life. Most of us are not going to own a holding company. Most of us are going to be buying stocks and maybe a company here and there. Maybe some of us own businesses, right? But if you're risk averse and you want to own technology, you can do quite well and still have great diversification. So this is food for thought. I'm not knocking Buffett's approach. He's very risk averse. Buffett is risk averse, doesn't want to lose money. I totally get it. I totally understand why. He was born in 1930. So he grew up in the Great Depression. His father, who made his way to Congress, got elected to Congress, but his father actually did very poorly in the Great Depression, like most people. So Buffett's, margin of safety and risk averse. I mean, he still lives in the same house, a tract home that he bought, 67 years ago in 1958. Can you imagine living in the same home for 67 years? I can't. I've bought and lived in so many different homes in more than one state. I could not imagine buying a home and staying there that long. I think I would go crazy. But then again, I'm a technology person. I prefer change. I like growth. I like the QQQ because you get a chance to experience growth with a lot of diversification. And that's not the only option to achieve this. So if you have any questions about this, I'm a fan of Berkshire Hathaway and Buffett because of the stability and the reputation and the ethical behavior. He tends to be reliably ethical. You can't really say the same with all businesses. But if you have any questions about this, please post in the comments and I'll answer your questions. And I really want to thank everyone for watching and have a great day.